So hello, thank you for joining us today. We are Team One. Aaron, Adam, Albert, Ann, and myself will be giving our bank analysis presentation. So we selected Bank of America as the bank for our presentation, and the competitor that we will use for the comparison is Citigroup. So these institutions are two of the four largest banks in the United States. Bank of America is the second largest bank in the nation, and Citigroup is the fourth largest. So I will be going over the 5-year cumulative returns. Adam will go over the share repurchases and the dividend policy. Ann will cover Ann will cover financial highlights. Then Aaron will talk about risk management, policies, and supervision. And he will also talk about fintech strategic planning. And last but not least, Albert will wrap it up and give you our buy, hold, or sell decision. Next slide, please. So here, we're going to start off with Bank of America. We can see the monthly stock price performance over the last 5 years on the left side. And we can see that for the most part, Bank of America has had an upward trend in its stock price. And however, one important thing to point out is that big dip in 2020 due to the pandemic. And we can see that it did come back from that decline. And on the right, we can see the 5-year monthly stock returns for Bank of America. And for the most part, they've been positive. And given this information, the 5-year cumulative returns for Bank of America are 196.44%. And they have had on average a monthly return of 2.25% over those 5 years. And so we can see that Bank of America has had significant returns over the last 5 years. Next slide, please. So here we have Citigroup. And again, the graph on the left has the 5-year monthly stock price. And it looks a lot like the graph for Bank of America. We can also see an overall upward trend over the last 5 years. And we can see that they also took a pretty big dive in 2020 as a result of the pandemic. And on the right, we can see the 5-year monthly stock returns for Citigroup. And again, mostly positive, pretty similar to Bank of America. And over the last 5 years, Citigroup has had a 5-year cumulative return of 75.66%. And they have had, on average, a monthly stock return of 1.5%. Next slide, please. So here we can see both Bank of America and Citigroup on the same graph. So on the left, we can see the 5-year monthly stock prices graphed against each other. And it does seem like Citigroup was doing better from the beginning up to the beginning of 2018. And then both banks seem to have had a decline in their stock prices through the majority of 2018. And this was mostly due to the overall market underperforming, and they were also interest rate hikes throughout this period. And that's what had a lot to do with these declines in their stock prices. And we can see that they bounced back. They had a pretty good run up in 2019. And then we can see both of them decline in 2020 due to the pandemic that was going on. And we can see that over the last 5 years, Bank of America has outperformed Citigroup with 5-year cumulative returns of 196.44% against Citigroup's 5-year cumulative return of 75.66%. And the 5-year average monthly returns for Bank of America also outperform those for Citigroup with 2.25 for Bank of America and 1.5 for Citigroup. And now I'm going to hand it over to Adam.
Thank you, Arturo. So I'm going to go over some of their share repurchase information, kind of what both Bank of America and Citigroup do with their share repurchases. First off, companies tend to repurchase shares for a couple of reasons. Can be due to many reasons, but the main two typically are to either boost the value of the stock or improve its financials overall. So they typically only do this when they have the cash on hand to do so, or the market is expected to rise. So the fact that Bank of America and Citigroup were both repurchasing shares to at least a high degree compared to the rest of the market is kind of showing that the virus really wasn't impacting this sector or these companies nearly as much as some of the more impacted parts or sectors that the virus really hurt. It definitely hurt, as you saw in the financials that Arturo just went over, but it wasn't nearly as bad for these two companies. If you want to move on to the next slide, Ann. So their dividend policy. Bank of America is kind of known for their dividends, but when comparing it to Citigroup, if you see these, the Citigroup, even with its price difference, is kind of up there with Bank of America and could even be considered better. So if you compare their dividend per share, Citigroup has a much stronger dividend per share than Bank of America. Bank of America just gives more dividends, but they just have a higher stock price. So if anything, they should be expected to give a little bit more. Depends on their financials, how they feel about dividends and such. And then how they feel with their with the virus and everything going on with the dividends. If you look in their 10K, only Bank of America mentioned how the virus and its continued adverse problems would be an impact on their dividends. And while this is just legal talk and it could really not mean anything, Citigroup had no such talk, and it just shows that Citigroup could potentially be trying to upkeep its dividend rate, potentially showing a discrepancy between the two companies. If you want to move on to the next slide. So if we want to go on to their annual dividend growth, 2 years ago in 2019, Citigroup had a kind of a crazy dividend growth. Both of the companies had kind of a crazy dividend growth of 24.68 for Citigroup and 22.22 for Bank of America, which is not normal, but it could be seen as the last year before with the virus hurting, just kind of shifting and showing we're okay, we're coming out of the virus strong, and we can provide more dividends. It comes down to a more stable 9 and 6.25 for each of the companies respectively in the next year, something that is a little bit more reasonable for each of these companies. But we see, again, Citigroup is kind of not only keeping up with Bank of America being the second biggest bank in the nation, but kind of showing them that their dividends are a bit stronger than them. I'm gonna go ahead and finish up my section with that and pass it off over to Ann.
Okay, thank you, Adam. So I'll talk about the financial highlights. Overall, in 5 years, Bank of America had higher revenues, an average of 1.2 times than Citigroup. However, Citigroup's revenues were increasing slightly during the period, while Bank of America's revenues were fluctuated and tend to decrease in 2020. In 2020, both net interest income and non-interest income of Bank of America went down, leading to a decrease of 5.7 billion in total revenues in 2020 compared to 2019. The decrease in net interest income was primarily driven by low interest rates due to the pandemic. However, looking at the net income graph, there is more to say about both companies. First, we will talk about Bank of America. In 2018, net income was 28.1 billion, increased up to 54% compared to 18.2 billion in 2017. And the improvement in the net income was driven by a decline in non-interest expense, a decrease in income tax expenses due to the impacts of the Tax Cuts and Jobs Act, and an increase in both net interest income and non-interest income. Impacts from the Tax Act include a reduction in the federal corporate income tax rate to 21% from 35%. In 2020, net income was 17.9 billion, went down nearly 35% compared to 27.4 billion in 2019. The decline in the net income was primarily due to the higher provision for credit losses driven by the weaker economic outlook related to the COVID-19 and lower total revenue as mentioned in the previous slide. On the other hand, in 2017, Citigroup reported a net loss of 6.8 billion compared to net income of 49 billion in the prior year. So Citi's full year 2017 result included the updated estimate for one-time non-cash charge of 22.6 billion related to the enactment of tax reform, and which was signed into law on December 22nd in 2017. So in 2020, Citigroup reported a net income of 11 billion compared to net income of 19.4 billion in the previous year. So the net income declined 43% and significantly higher because like the credit cost and higher expenses, while the revenues remained largely unchanged from 2019 to 2020. So move to the next slide. I'll talk about basic earnings per share, and it's computed by dividing income available to common stockholders after the allocation of dividends and undistributed earnings to the participating securities by the weighted average number of common shares outstanding for the period. Because of the number of common shares outstanding in both Bank of America and Citigroup did not change significantly, so their earnings per share were affected mostly by their net income, and this is the reason why like we have like Citigroup had a negative 2.98 earnings per share like in 2017, and both two companies' earnings per share decreased in 2020. So talking more about like DuPont analysis, this is the framework for analyzing fundamental performance originally popularized by DuPont Corporation, and the DuPont analysis is a useful technique used to decompose like the different drivers of return on equity. And we can see on the slide that the DuPont equation focuses on operating efficiency, which is profit margin, the asset utilization, which is total asset turnover, and the debt utilization, which is equity multiplier. So here's how we calculate the DuPont analysis for Bank of America. And we looking at the last four rows of the table, we can see that a large part of return on equity is equity multiplier. However, the Bank of America's profit margin seems to be high. So let's see how the DuPont calculation of Citigroup. Except as Bank of America, the main part of return on equity is equity multiplier. And looking at look like the Citigroup has a lower profit margins compared to Bank of America. This is easier to put those numbers on a chart and compare. So we move to the next slide. So the net profit margin here, like we have like the Bank of America have a higher profit margin than like Citigroup. And looking at the three graphs, we can see that a large portion of the two banks' return on equity results from their equity multiplier, and there's not any big difference between two banks in asset turnover. However, like Citigroup has a higher equity multiplier compared to Bank of America, but smaller profit margin. So the final return on equity of Bank of America is better, and the investment in Bank of America seems to be preferable based on the DuPont analysis. However, before having the final decision, Aaron will talk more about the risk management and the fintech plan in both banks.
Okay, so going into risk management policies and supervision, going into risks, there are 7 types of risk, which are strategic, credit, market, liquidity, compliance, operational, and reputational. In order for any risk prevention, Bank of America has their own risk management process, which is identify, measure, monitor, and control. Risk can be imminent through all business activities, but Bank of America leverages sound risk management in order to provide for their customers and also to deliver for their shareholders. If it's not managed well, risk can result in financial loss, regulatory sanctions, and penalties, which can lead to a company's reputation to be damaged. In result of each of these consequences, it may adversely impact the ability to execute their business strategies. Bank of America takes a comprehensive approach to risk management with a defined risk framework and an articulated risk appetite statement, which are approved annually by the ERC and the board. On the other hand, for Citi, effective risk management is a primary importance to its overall operations. Citi's risk management process has been designed to monitor, evaluate, and also manage the principal risks it assumes in conducting its activities. Citi is continuing its efforts to comply with the Federal Reserve Board and the OCC consent orders relating principally to various aspects of risk management, compliance, data quality management, and governance, along with internal controls. Under Citi's mission and value proposition, which was developed by its senior leadership and distributed throughout the company, Citi strives to serve its clients as a trusted partner by responsibly providing financial services that enable growth and economic progress while earning and maintaining the public's trust by constantly adhering to the highest ethical standards. And on to fintech and strategic planning. So Bank of America is being one of the largest digital financial service providers, is coming across different fintech strategic plans as they plan to modify or adapt the existing products and services. So Bank of America is growing and is developing its online and mobile banking channel strategies in addition to remote connectivity solutions. For example, they have Merrill Edge is an electronic trading platform provided by Bank of America Securities. This electronic trading platform was released by Bank of America in June 2010. Merrill Edge was created to merge Bank of America online investing and also Merrill Lynch's research, investment tools, and call center council. So when it was established, Merrill Lynch had about roughly 500,000 Bank of America customers. Merrill Edge provides investment advice along with client brokerage asset services, a self-directed online investing platform, and key banking capabilities, including access to the corporation's network of financial centers and ATMs. So Bank of America will also introduce a digital tool called the Life Plan. So this Life Plan aimed to help clients with setting and keeping track of their financial goals. The new tool is now available on the Bank of America digital app, also on their website. So the Life Plan allows the Bank of America's customers to specify and also prioritize their important financial goals at different stages in their life. And lastly, as of last year, Citigroup made a strategic investment in the Genesis Global Technology Limited. This is a London-based startup that develops technology to make it cheaper and faster for financial firms to build applications, such as a trading system and platform. Genesis technology can potentially help Citi on average become 80% faster than building an application from scratch. So Citi was selected by the Boni Value Public Trading Enterprise Limited to act as a custodian for the underlying bonds traded on its digital exchange as a fractionalized asset. And under the agreement, Citi will provide asset safekeeping and servicing solutions. And Albert will finish up with our presentation.
So is it a buy, hold, or sell? We have a neutral rating on Bank of America because we see modest growth in terms of their leading franchises, which are in community banking, small business loans, and consumer card and loans. We don't see much recovery in this area until in 2021, until the government stimulus is fully used. The bank, B of A, is very dependent on higher loan volumes and in these markets, because it is through these markets that they pick up additional service fees and add on to their net interest income. Yes, B of A did post in Q1 of 2021 an earnings per share of 86 cents, and that beat the street or the consensus by 21 cents with a wide margin. But we need to remember that revenue year on year was flat. So given the closing price of Bank of America last Friday of $39.15, it is very close to our target price of $40, using a 13.1 multiple on this year's earnings of $3.05. This multiple is actually higher than the 5-year average of 12 times price earnings multiple. So with that, we are neutral. If you are long the stock, it's a hold. If you don't have the stock, we do not encourage initiating a new position. Thank you.